Hello, folks. It is Sunday, March 12, and wow, has it been an interesting week. Obviously, we had one major bank and another bank, crypto-related bank, collapse last week in the last 3 business days of last week. So very recent news. Lots of information out there, videos, articles, lots of people talking about the banking collapse. And so you go out there if you're interested. You spend all day, spend multiple days reading information about the banking and crypto crash that is, I believe, underway, just starting. Um, Another piece of news that is certainly not getting press that I've seen in the West. um, Saudi Arabia and Iran had a rapprochement last week, meaning they're, not that they're buddy buddy, but they're moving in that direction. They're de-icing the ice wall that's been between the animosity that's been between those two countries, and that deal was brokered by China. And so China is taking steps in the last, certainly in the last 6 months. Um, they are moving onto the world's stage as the new leader of the world. U.S. hegemony it's done. You know, Western leaders haven't accepted that yet, and of course, they're not going to. They're not going to just fold up their tent and walk away. I mean, that none of us would. You're not just going to say, okay, I guess it's China's turn to be world leader, and I'm okay with that. But that's reality, in my opinion. And, this isn't the first time that empires have changed. Obviously, the British Empire ruled the world before, the West, before the United States took over America, the light on the hill and all that. Um, we haven't been the world's leader forever, and we won't be the world's leader forever. And it's looking more and more like China uh, is the new world leader, and they're taking that role increasingly in international relations. And so, anyway, in case that hasn't crossed your radar yet, be aware that last week China brokered a rapprochement between Saudi Arabia and Iran. Interesting. So Saudi Arabia has been a nominal ally of the United States. The petrodollar, obviously that's a U.S. Saudi Arabia relationship, has been in place since 1974. That's ending, if it's not already over. And Iran has been one of the United States' biggest enemies. We've got sanctions, and we're threatening, and Israel's threatening, and so interesting that one of America's strongest allies and one of America's worst enemies are now playing buddy buddy, which reminds me of that saying, my friend is my enemy's enemy, something like that, something along those lines. Anyway, interesting changes on the international scene. And related to that, China's part of what China's up to right now is the Belt and Road Initiative. And they want to put their trains into Eurasia and all the way into Europe. Those train lines, the train tracks run through Ukraine. And so China wants to see an end to the conflict in Ukraine because they want to build their Belt and Road initiative. They want to put train tracks through Ukraine. And so, if you're looking at who's on America's side when it comes to the situation in Ukraine, well, it's Ukraine. Reluctantly, the rest of the Western powers, which, increasingly that's fading. Anyway, enough on international events. Let's focus now on crypto and banking. And I'm going to start with, we're going to get to charts. I've got banking charts. I've got crypto charts. There's some interesting things that we'll talk about in the charts. But first of all, I want to just share some information. I do this as a service to you folks. I don't have any money in banking stocks. I don't have any money in crypto. I've eliminated my exposure to banks that have exposure to derivatives. This information is for you. I'm sharing this information for you. So and hoping that you will take appropriate action based on this information. I've been telling you for months that there's a global debt collapse happening, and and when I'm eyeball to eyeball with somebody and I tell them that, they look at me like I got three heads or I'm stupid, don't know what I'm talking about. I'm hoping that when you see in the mainstream media that two banks failed last week, that it's like, oh, yeah, Brian said there was a global debt collapse occurring. Maybe this is related. Anyway, I find value in this pyramid. This is Exeter's pyramid. And what he is depicting here is the idea that at the bottom of the financial pyramid, everything is based on gold. The only tangible good in our financial system is physical precious metals. And of course, nobody openly acknowledges silver as a financial asset that we build on. It's always pointed at gold. And so as these paper assets collapse, what we're left with is gold. Gold will be the last man standing as the financial system continues to unwind. At the top of the pyramid, obviously, is derivatives. The numbers have changed. It used to be, it's quadrillions. So that's a Q, quadrillions. I'm not sure. I think that's 12 zeros to get a quadrillion. That's the amount of global exposure to derivatives. It's in the quadrillions. We collapse down to there, and then we get into commodities, real estate. You could read the list. At the bottom of the pyramid is gold, last man standing. And so keep this image in mind as you're thinking about your own your wealth, whatever it is you consider your wealth, stocks, bonds, precious metals. Think about your wealth relative to this pyramid, and where do you really want to be right now? Where on this pyramid do you feel safe? Hey, if you feel safe in derivatives, more power to you. You want to be in bonds? That's great. But think about it. Give it some thought. Where do I really want to be exposed right now? Let's talk about derivatives and banks, and bank in particular, banks with exposure to derivatives. Now, this report, first quarter of 22, Office of the Comptroller of the Currency. You can go out and find this. Just search on, Office of Comptroller quarterly derivatives report, and you'll find this. And in this report, they provide a list. They provide a list. Hello. Of all the banks that have exposure to derivatives. And I'm going to pause the video right here for a second. The reason I stopped the video there, folks, is I was not seeing the information that I expected to see in that report. I expect what has happened is that since I looked at that report, it has been edited. What they're currently listing is the top 25 banks with derivative exposure. The original report, the first time I looked at this report, they were listing 1,200 banks with derivative exposure. This is from Hal Turner back in mid-22. And so go search Hal Turner derivative time bomb, and you'll find this article. Um, it's one of the drawbacks. I mean, the internet is an amazing, just amazing technology. But one of the challenges with digital media, digital assets, is that they can be changed, and I believe we're seeing a case of that. Um, we've gone from 1,200 banks with derivative exposure to now the report's only showing us the top 25. And so go find this article. You'll find the original list. I'll poke around and see if I can find this list from a government source. The point, the reason I'd like you to look at this list is to see if your bank is on it. And let me share with you my own experience. I moved out of Southern California to a small town elsewhere, and moved my bank. Wells Fargo had been my primary bank for 20 years, more than 20 years. Look at that. What have they got? Is that, let's see, that's millions, billions, trillions, 11, no, was that? That's that's millions, that's billions. Is that trillion? $11 trillion. So Wells Fargo with $11 trillion in exposure to derivatives. And so anyway, I didn't feel safe having my money in Wells Fargo. Moved to a small regional bank, 5 branches, didn't do any research before I made the move. And then a couple of days later, I was thinking about it. It's like, I ought to at least check and see if that bank does have any derivative exposure. And sure enough, there was my regional bank with more than $400 million worth of exposure to derivatives. And so I did my research then and found another local bank with zero derivative exposure, and went the following day and opened accounts at that bank, and actually met the president of the bank. That's where he has his office. And so I met the president of the local bank while I was there opening accounts. Had a little conversation with him about derivative exposure. And he explained that their philosophy at that bank, they don't invest in things they don't understand. That, basically derivatives are these fuzzy things that average people don't understand. So anyway, I encourage you to find Hal Turner, derivative time bomb, look at this list. If you're banking at one of these banks, you might consider doing something different. And so anyway, that's derivative banks with derivatives exposure. Let's keep rolling. Like I said, there's a lot of threads to connect here. It's going to be an interesting week going forward to see what fallout we have in the banking and crypto space. Some of the dots, some of the stuff that's going on in the background, just to factor into your thinking. And obviously more stuff will be unveiled going forward. So let's just go through the list. So currently, Jamie Dimon is in the news. He's being investigated for financing Jeffrey Epstein's activities. And so you can imagine that he doesn't like Jamie Dimon doesn't like being on the front page, especially when his name is being connected with Jeffrey Epstein. And so, just a coincidence that we have a banking collapse that takes Jamie Dimon off the front page. Coincidence, maybe, maybe not. You can decide that for yourself. Silicon Valley Bank, SVB, that's the second largest bank collapse in history, and it's one thing. It's like we talk about, bank collapsed last week, who cares? Well, this is the 18th largest bank in the United States, and again, the second largest banking collapse in history. Is that significant? I would say so. Did we just see the start of another 2008? Or did we just see the start of another 1929? I mean, how bad is it? What will the fallout from this ultimately be? We'll only know in hindsight. Bob Moriarty has a new video out today. You can find it on his website, 321gold.com. He's suggesting that this is 1929, not 2008. So, as the 18th largest bank, obviously that's competition for JPM. And so not only does the banking collapse get Jamie Dimon's name off of the front pages, it also eliminates one of his competitors. So, nothing wrong, well, from his perspective, nothing wrong with collapsing your competitors if you have an opportunity to. And knowing JP Morgan, they were almost certainly short. They were almost certainly shorting Silicon Valley Bank. Actually, you'd have to do it's the parent company. The symbol is SIVB. But anyway, I'd be willing to bet at least $100 that JPM was short SVB going into last week. These say just amazing. So the CEO of Silver Valley Bank he no longer sits on the board of directors at the San Francisco Federal Reserve. As on March 10, there was an announcement that this gentleman, his name is, I got it here, hang on a second, Gregory something, Greg Becker. So Greg Becker, the CEO of Silver Valley Bank, was sitting on the board of directors at the San Francisco Federal Reserve. Well, isn't that interesting? He was also on the board of directors at Silvergate Bank. And Silvergate Bank, that's the second bank that collapsed. Well, actually, I think it was, it was Silvergate on Wednesday. Silvergate collapsed on Wednesday. Silicon Valley was Friday. And so anyway, this Greg Becker sits on the board of Silvergate Bank. Silvergate Bank received a $4.3 billion loan from the Federal Reserve. And so those 3 bullet points right there, that's an interesting chain of interconnectedness. That's all the way from the Fed down to this collapsed crypto bank. 3 of the insiders at Silver Valley Bank, they sold approximately 30%, each of them sold about 30% of their stock within 1 week before the collapse. So they knew where things were headed. All right, let's keep rolling. A few ideas to keep in mind as events unfold. So, one of the big things that people are talking about is, that the FDIC insures banking deposits up to $250,000 and all these depositors will be made whole and blah, 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 blah. Well, let's keep in mind that the FDIC has less than 1 penny for every dollar they claim to insure. So, some people get bailed out. At some point, the FDIC runs out of money. And it actually runs out of money pretty quickly because they don't have anywhere near enough money to back all of the deposits that they claim to insure. This one, it's so easy to forget this one because of the changes, relaxing of banking laws. I think this was part of the Dodd-Frank legislation, that banks don't have to mark their assets to market. And so they go out and they buy $1 million worth of bonds. Those bonds go on the books as an asset at $1 million. And that value never changed. Well, they probably mark it up. I mean, if they went to 1.5 million, they'd have that asset on their books at 1.5 million. If it dropped to 500,000, the law does not require them to change the entry in their bookkeeping to the new value. And so this is one of the things that came to light in the collapse of the banks during the past week, when they were forced to liquidate some of their, air quotes around assets, when they were forced to liquidate some of their assets because of their cash flow situation, basically a run on the bank, depositors pulling money, their $1 million worth of bonds, well, they weren't worth $1 million. They were worth far less than that. And when they go to sell, of course, the market doesn't care what they're holding on their books. I don't care that you paid $1 million for those bonds. That's not what they're worth today. And so if we look at that, if we dig into that idea a little bit deeper, so how bad have bonds been hit? Obviously, interest rates have been rising dramatically for the last 2 years. And so bond values decline as interest rates rise. And so, obviously interest rates have been rising, so bond values have been dropping, but the question is how much? If we look at bond ETFs, they are down at least 15%. And so we can assume that the bonds that banks are holding as assets at purchase price on their books, they're actually worth 15% less than what the banks are claiming they are worth. And the banks are holding bonds as assets. Okay, let's see, what do we got here? That's a duplicate. So let's jump into some charts. This is Silvergate Bank. They were the first, they collapsed on Wednesday. I collapsed. I guess that's a strong word, but I'm not sure what other word to use. Look at the volume, huge volume coming in, dropped below. Can you even talk about that being a support level? They're basically they've dropped below their starting point. That was the initiation of Silvergate Bank. They're below that value now. What's the target? Well, obviously the target is 0. We'll see in receivership what the shares end up being worth. I don't even know, are they trading? If we wanted to go in and short this thing Monday morning, would we be able to? I'm not sure. And I'm not suggesting that anybody do that. This is the other collapsed bank. This was on Friday. This is Silver Valley Bank. Huge drop. What is that? Down 60%. So a 60% drop during the trading session, normal trading hours on Friday. And then my understanding is that in aftermarket, they dropped another 40%. Another 40%. Doesn't take them to 0, but they're well on their way. And 60% decline during the trading session, another 40% in the aftermarket. Huge drop. Obviously, everybody's bailing on their share. Everybody who can is bailing on their shares. And just think about that. As an average retail investor, you were working all day. You weren't following the financial news. You didn't know that Silicon Valley Bank collapsed during the day. You get home and you see that in the news. Well, you're stuck holding your shares until Monday, whereas the insiders and people who have accounts that let them trade in the after hour market, they're still able to bail. And they did. Again, aftermarket, Silicon Valley dropped another 40%. And those retail holders of this this company, they're stuck till Monday. And so they'll come in Monday morning. Will they be able to sell their shares Monday morning? Again, we don't know. Will Silicon Valley be trading Monday? We'll see. Notice notice in this stock there was no buying. This is all selling volume, and a bunch of it. Big look look at that volume bar relative to the last year of trading. I mean, just awesome amount of volume in that bar. Keep that in mind as we look at the major bank stocks. So this is a banking index, NASDAQ banking index. Just big decline. Started on Wednesday, obviously triggered by the Silvergate collapse, and then accelerated going into the week. That was actually Tuesday. What happened on Tuesday? So I guess enough people knew ahead of time that Wednesday Silvergate was in trouble, and they started bailing on Tuesday. So anyway, that's interesting. Big decline. But notice that in contrast to Silvergate, no bounce. Little bitty bounce there at the end of the trading session, I guess you could say. A better bounce here. Let's keep going. This is Bank of America. Now, this is where, to me, this is interesting. Let me get this stuff. Let me get these indicators. Nothing really to see in the indicators. Bear mode on a sell signal, not surprising. Energy low. Notice the volume. So big volume, but look at the price action. So we get a big plunge down below these obvious support levels. Clearly this is a support zone. We've got support at the lower median line of this shift pitchfork. Notice where BAC closes, just above the support level. And so somebody came in. Let's drop down. This is down in the 30-minute time frame, and so there's the big burst of selling, and we could talk about that being a capitulation, down into that big burst of selling. Then we get a little bit of a bounce and then buying, and we don't know who's buying this thing, but reasonable, in my opinion, to assume that it was either, well, almost certainly Bank of America is buying their own shares, and likely JPM as well, buying shares of the major banks. And whether it was JPM on their own books or JPM on behalf of the U.S. Fed or the U.S. Fed directly, they've got a trading bench. Anyway, somebody decided to buy shares in the major banks on Friday afternoon, and they chose not to buy shares in Silvergate or Silicon Valley Bank. Here again, Wells Fargo bounce, held its support, and then a bounce off the low on Friday. Big volume. Citigroup, the Citi Bank, same thing. Somebody buying on Friday afternoon. U.S. Bank Corp, not as obvious. Looks, that that's a big collapse. Interesting there. So again, started on Tuesday, accelerated on Thursday, and then on Friday, the big plunge on volume, but somebody decided to buy. If we look at, say, Tuesday's action's not as pronounced in, well, I guess it is. Yeah, so all of the banks started to drop on Tuesday. I'll have to look into that. So anyway, selling on big volume Here's JPM itself. Yeah, now look at that. JPM actually managed to get a green bar in on Friday, and certainly didn't experience the decline, the dramatic decline. Well, let's see. So there was Thursday. That was a 9. Is that 9% or 5%? 5.4%. And here we had 7%. This is Thursday decline, 4%. So I guess they're all about 6%. Yeah, so they're all in the same ballpark. But that's the first green bar we've seen on Friday in a bank stock. Big volume. And again, is this JPM buying their own stock, the Fed buying stocks in all of the major banks, probably some of both. So anyway, those are the charts of the banking stocks. Again, I don't invest in the banking stocks, so I'm limited amount of interest in the banking stocks. It'll be interesting to see how they behave in the week going forward. Now let's talk about crypto. Both of these banks that have collapsed had ties into crypto. Certainly Silvergate did. That was the Wednesday collapse. Evidently there was a vacuum. Nobody wanted to act as banker for these crypto related companies. And so Silvergate stepped into that vacuum, and it cost them. It cost them dearly. It cost them their business. But the fallout is rippling through the crypto space. We don't know what the connection between FTX and these two banks, what if any connection exists. That will likely be coming out. But we do know that when FTX filed their bankruptcy, they listed almost 200 companies that could be affected by the FTX bankruptcy. I've got that list. I forgot to put that in here. I don't think it's in this set of. I don't think we're going to see that in this video, but you can go find that if you'd like. It's just search on companies affected by FTX bankruptcy. And so anyway, throughout the crypto space, I suspect we're seeing fallout from the FTX bankruptcy with these banking collapses. We can see, Bitcoin obviously was not happy. Let's go back to this is daily time frame. We can see there's Thursday we had a 9% drop. Friday, not much of a drop and actually a little bit of a bounce. Sliced right through the 50-day and 200-day moving averages, and of course those will act as resistance levels overhead if Bitcoin tries to rally. Weekly time frame, big drop, 10% on the week. Let's see, Bitcoin monthly. Now, since we're talking about banks and Bitcoin, crypto, this chart and the timing of this was the first Bitcoin ETF. It was 19 October 2021. Just a coincidence, and when I say that, it's tongue in cheek. Trust me. Just a coincidence that they launched the first, Wall Street launched the first Bitcoin ETF at the very peak of Bitcoin's value. I mean, if that's not a classic pump and dump scheme, I don't know what is. And of course, any investor who thought, Bitcoin's going to the moon, I want to be on board, and they invested in this ETF with Bitcoin at 65,000. They're down, it's not 77%, they're down, I don't know, is that 60%, 65%? Anyway, they've lost a significant amount of their money, anybody that chose to invest in Bitcoin ETFs. And there were several launched after this one. That was the first one. So Litecoin, obviously, big drop. This is weekly time frame. That's 23%. So it doesn't look like much on this chart, but that was a 23% drop in Litecoin in 1 week. That's not good. Looks like it's finding support currently at the 40-week moving average. Big bump in volume on Friday's move. Sigh. Coinbase, this is daily time frame. That's incorrect. Sorry about that. I was popping around this morning looking at charts, trying to decide how to best convey to you the idea that crypto is crashing. Its intrinsic value is zero. All of the coins in tokens are worth zero. They're currently sporting values above zero, but their intrinsic value is zero, and I believe, my opinion, that's where they're headed. So a lot of volatility. So we can see, and here again, that was, Tuesday. So I have to see what happened on Tuesday. A lot of volatility Tuesday, Wednesday, Thursday, and then the big drop on Friday. And notice that we've closed below the support level, and that is an impulsive or high energy bar where the close of the vehicle is almost at the low of the day. And so that's a bearish indication, and also an indication of elevated energy. Although notice that's interesting. So based on stochastics, this is my my go-to, my quick measure of energy in a vehicle is slow stochastics. It's showing low, but that's a high energy price bar. So with close near the low. So just interesting divergence between those two reads on energy level. This is Circle versus Tether. And, this is supposed to be a stable relationship, 1-to-1, they're worth $1 until they aren't. And so you can see here on Thursday and Friday, they were no longer worth $1. And, you could argue that it's like, oh, okay, well, that's no big deal. They dropped a penny or 2 pennies. What? Yeah, no, it's a little bit over a penny. Who cares? Well, the key to focus on or to understand is that they broke the dollar. That this is supposed to be $1 and it ain't. And so anyway, that's an interesting relationship. These stable coins are also being affected by the fallout in the crypto space. Action steps. So what can we do? What can we do to protect ourselves? Well, get out of banks with exposure to the derivatives and do your research, do your due diligence. Don't just assume that a local or small bank doesn't have exposure to derivatives. As I shared my own experience, I did that. I changed banks without doing my research, and I ended up in another bank that had exposure to derivatives. So certainly not as bad as Wells Fargo, but still had more, any number above zero. When we're talking about exposure to derivatives and where I want to put my money, any number above zero is a number that's too big. And so I'm now banking at a bank that has zero exposure to derivatives. Now some people on this point, they'll say, oh, well, all you do is go to a credit union. It's easy to join a credit union. Well, the credit unions are no better than the banks. They're insured. It's not FDIC, it's CDUC, I think, something like that. Anyway, there's another organization that insures credit unions. I haven't done the research. I don't know how well funded it is. I would guess that it's along the same lines as FDIC. They unable to back. If everybody in the credit unions wanted to pull their deposits, they don't have enough backing to cover. Get out of stocks, get out of bonds, move into physical precious metals. I've always said that. If you haven't picked up on it yet, I'm telling you today, get out of stocks, get out of bonds, move into physical precious metals, have some cash on hand, have some food on hand. I'm not going to say that one out loud. You can read for yourself. If you don't understand what that means, ask somebody. I'm sure they'll be they'll be glad to tell you. You can go out and you can find this list. Hal Turner's radio show, derivatives time bomb. Just Google that. Whatever search engine you use, you'll find that list. And just a reminder, we can look. So look. If we go to the bottom, I'm not going to scroll. Let me do that. So what do we got here? 1,253 banks with 1,252 banks with exposure to derivatives. And then Hal, well, actually it wasn't Hal. The author of this article is McCallum, I believe. We'll look before we close here. He provided a link. And the first time I followed this link to the report that I showed you, this report, it included this list of 1,200. It doesn't include that list today, and so you'll have to go find Hal's article to get the full list. But that, we'll follow that link right now, and there's the report. That's what I showed you. And it does not include 1,200. There's no list of 1,200 in there, but it used to. So that report has been edited, I believe. Yeah, that's the report again. That's all I've got for us today. Apologize for running long. Don't typically run this long. Again, I do this for you. This isn't for me. I like I said, I don't have exposure to bank stocks, not exposed to crypto. I'm out of the banks that have derivative exposure. This information is for you. I hope you'll use it. I'll talk to you soon, folks.